NISM Course Part 14. Public Issue of Debt Securities and Government Securities. Regulatory Requirements. This section focuses on the regulatory requirements and procedures for issuing debt instruments in the primary market, specifically covering corporate debt and government securities. Corporate debt public issues. A company can raise debt capital from the public by issuing securities like debentures through a prospectus. This is regulated by the Companies Act and the SEBI, Issue and Listing of Non-Convertible Securities, Regulations, 2021, SEBI, NCS, Regulations. Eligibility and Offer. An unlisted company can make a public issue of debentures. The process requires filing a draft offer document, prospectus, with the stock exchanges and SEBI. Credit rating. Obtaining a credit rating from at least one SEBI-registered credit rating agency and disclosing it in the offer document is mandatory. This helps investors assess default risk. Investor protection. Debenture trustees must be appointed to safeguard the interests of debenture holders. They ensure that secured assets are adequate to meet obligations. Minimum subscription. The issue must receive a minimum subscription of 75% of the base issue size, or the issuer must refund the application monies. Redemption reserve. The issuer must create a debenture redemption reserve by transferring a portion of profits each year until redemption. Shelf prospectus. Eligible entities, like banks, NBFCs, or public financial institutions, can file a shelf prospectus for multiple issues of debt securities over a period, issuing subsequent tranches via a simplified tranche prospectus. Process for Government Securities, GSECs. Government securities, GSECs, are debt instruments issued by the RBI on behalf of the government and are governed by the Government Securities Act, not SEBI. Auction mechanism. The RBI conducts periodic auctions for GSECs, like treasury bills and long-term bonds, according to a pre-announced calendar. Competitive bidding. This is open mainly to institutional participants like scheduled commercial banks and primary dealers who bid for securities through a process where the price yield is discovered. Non-competitive bidding. This route is available for smaller investors who lack expertise, e.g., cooperative banks, mutual funds, companies. These bidders receive allotment at the weighted average price or yield resulting from the competitive bidding process. Retail access. RBI has allowed retail individual investors to participate in the primary GSEC market through stock exchanges via the non-competitive bidding route.